Hey everyone, and welcome back. As I'm sure some of you are aware, 45 days after the end of the second calendar quarter, and well, at the end of every quarter, but this time it's at the end of the second quarter, institutional investors who have assets under management of more than $100 million in the United States are required to submit an SEC filing called the 13F. And it's within that 13F filing that these big investors are required to show us all of their stock market assets that are within the fund or the company's portfolio. And as us small guys, little fish in the big pond, we are able to get an insight into what stocks are in their portfolios. But more interesting to me, we can see what changes have happened over the past 3 months. Because whenever these filings come out, we get a snapshot of their portfolio and we can compare that to their portfolios in the previous quarter and see what assets they bought and didn't previously held. We can see what stocks they had previously but have sold out completely of, and we can also see where they've added partially or reduced some of their positions. Over the next week, I'm going to be releasing a few videos going through the portfolios of some of the biggest investors like Warren Buffett, Charlie Munger, Monish Pabrai, and more. So stay tuned for those and make sure you're subscribed so you don't miss those videos. But in today's video, what we're going to do is take a look at the 5 stocks that have been purchased or added to the most by the super investors during this quarter. The website Dataroma puts together the 13F filings for some of the most successful investors. There's a list of, I think, maybe 30 to 50 different investors, and it's from Dataroma that we're able to see of those so-called super investors, what have they been buying and what are the most common purchases between those investors. So not only am I going to go through the list, I'll also talk a little bit about each business and their potential valuation. And then I'm also overall just going to give a summary of what are my thoughts about the market in general and how that relates to how these super investors are investing in the markets and approaching the markets now that we're halfway through 2021. So sit back and relax. And if you do get some value out of today's video, make sure you leave a like on the video. And if you want to be up to date and get notified when I post the other videos related to these 13F filings throughout the next week and beyond, then make sure you hit that subscribe button. And as I said, if you want to get notified, just hit that notification bell next to the subscription button. But with that said, let's jump into the video. Now, as I mentioned, I'm going to be going through the top 5 buys from these super investors in this video, but I'm not going to talk equally or spend an equal amount of time on each of them. I think there are certain ones, and I'm sure people know what I'm hinting at here, that I will want to talk more about and flesh out a little bit more. So for some of these earlier ones in the list, I might just give a very quick summary. But number 5 on today's list is Visa Incorporated, which is of course the largest payment processing business in the world. In order to be number 5 on today's list, Visa was purchased or added to by 6 different super investors during the period. And overall, comparing all of these super investors, Visa currently represents 0.9% of their portfolios on average. Now, as you can see, all of these 6 investors already had a position of some sort in Visa because they're all adding to the position rather than buying it for the first time. And you can also see that the change in portfolio is pretty small. None of these were massive investments that were multiple percentage points of any of the portfolios. In fact, the biggest change was from Maverick Capital, which increased their position by 0.44% of their portfolio. And it really doesn't surprise me to know that Visa is one of the most frequently purchased stocks by super investors and is also one of the most well-held stock by super investors and investors in general, because it really is a business that has a super powerful competitive advantage, and it has super consistent cash flows and massive profit margins to protect its downside during weak economic activity. Visa and MasterCard dominate 90+% of the payments industry worldwide, and whenever there is a new business or an individual that is considering accepting payments from Visa or getting a card that is Visa branded, there's really no question. It's either you will go with MasterCard or Visa, and that's it. And the reason why is because of their powerful networking effect competitive advantage. A networking effect is where the value of a product or service increases as more customers are using it. And in Visa's case, as more people use Visa cards or have Visa cards, which at the moment, most people have Visa cards or MasterCard, both of them kind of have this duopoly position in the market. but pretty much everyone has them. So that means that every business wants to accept Visa or MasterCard. And that means that if a new business is setting up shop and they're considering which cards to accept, they're going to accept Visa because they know that most customers have a Visa or a MasterCard. And the same thing is true when a customer wants to get a new credit or debit card. They want it to be Visa or MasterCard because they know that it will be accepted everywhere. And what that means is it's extremely difficult for other businesses to move into this industry and compete against Visa and MasterCard. And what you actually see now is that whenever businesses do move into the payments industry, like Apple, for example, they put it on top of the Visa or MasterCard network rather than trying to compete directly against them. The problem with how good Visa's business is that it's obvious to everyone. And as a result, the stock's price has baked in all of the benefits, or a significant portion of the benefit that Visa will and has generated and will generate in the future. And if we're doing a very, very quick discounted cash flow to kind of feel out where the market sees the business going in the future, we can see that if we wanted to make a 15% return, then we would need to be assuming 28% or around 28% per year growth in profits for the next 10 years to justify or to expect an approximate return of 15% on our investment. And that may certainly be a possible outcome for Visa, but when I'm making investments, I'm not looking to bet on something that might happen, or that is a 5% chance of happening or a 10% chance of happening. When I'm modeling in my discounted cash flow, I want to be coming up with an idea of what is the most likely outcome. What's a 60, 70, 80% chance of occurring, and investing based on that, and with a margin of safety on top of it. So for Visa, I think it's a really great business, but it's not one that I'm particularly interested in right now based on its price. And a similar thing can be said for number 4 on today's list. I think it's a really great business, but again, I think its price beckons that it performs extremely well in the future, and maybe it will, but this business is the Walt Disney Company. Disney also had 6 super investors invest into this company during the period, and over all these super investors, it averages 0.7% of their portfolios. In Disney's case, there was one super investor who did not hold Disney in the previous quarter and invested significantly into it this quarter, that being Pat Dorsey of Dorsey Asset Management. He bought 709,000 shares, and that reflects 9.4% of his portfolio. We also saw 5 other super investors add to their positions, the most significant coming from Linsell Train, who added just under 400,000 shares for a change of almost 1% in their portfolio. Disney at the moment is kind of in the rebuilding stage of their business. They've kind of gone through a couple of different things that have caused them to be very, very unprofitable, at least in the short term. First of all, they're spending a lot of money to invest in their streaming platform, Disney Plus, as well as ESPN, and a couple of others. They have Hotstar and Hulu. And on top of that, because of the pandemic, some of their other businesses have been performing extremely bad. Their theme parks, for example, have been hit with closures and restrictions on how many people they can have. And then, of course, the box office sales for some of their movies has also been hit significantly during the pandemic. But all of this is very much short-term problems that Disney is facing, and it's in no means reflective of where the business is going over the long term, at least in my view. And I think that Disney is, and I think this is quite obvious, that Disney is at somewhat of an inflection point, right? Their business model is changing massively. They're bringing in significant revenue now from Disney Plus with over 120 million subscribers, I think. And that will likely continue to grow over time. But what you're also likely to see out of Disney is that their cable and broadcast networks, as well as some of their box office sales, going down over time and being cannibalized by this new streaming business model. So the question going forward is, how much can they reasonably expect to get out of their streaming service customers, and what are they going to lose in ad revenue from people who are turning off their cable or canceling their cable bill, and then even just watching less broadcast television and instead spending more time on streaming services? And what does that relationship look like? That, of course, is the question you need to be answering if you want to invest in Disney. And at the moment, the market thinks that Disney is going to do extremely well. Again, using the same logic as with Visa, Disney would require about 24% or higher per year growth for the next decade from 2019 levels, not from 2020 levels, in order to justify their current price. Moving on, number 3 for today is Amazon.com. Amazon.com, of course, is the e-commerce giant coming out of the United States, but it's really a global business now. And there were actually 7 super investors who invested into Amazon during the quarter. And for Amazon, again, similar to Visa, all of these super investors already had positions in Visa and were just adding to them. The only significant change came out of Viking Global Investors, who invested just under 300,000 shares, an additional 300,000 shares, I should say, to add 3% of their portfolio into Amazon. And Amazon has done extremely well recently. They're a 4-bagger over the past 5 years, although they have actually been flat over the past 12 months. But to me, that makes complete sense. Amazon previously has had outrageous valuations, so it makes perfect sense that we're going to see a 12, maybe 24, maybe even longer period where the stock price is going to grow at a much slower rate than their underlying business. Because in the previous 5 years, yes, their business has accelerated at a huge rate, but the stock price has grown faster than their business. And what that means is, well, unless their business was undervalued previously, which I don't think it was, that means that it's probably went into overvalued territory and the business needs to catch up over 1, 2, or maybe even more years. It has to catch up to that stock price. And my story with Amazon is very similar to a lot of businesses that have a big brand name attached to them and that are growing at a high rate. I think it's a really, really great business. I just think its price is, it beckons that, again, it performs extremely well. And I'm not here to sit here and say that it won't do that. I just think the likelihood of a lot of these businesses that have massive valuations performing extremely well in the future is unlikely. Some of them will, and people who pick out those investments and those businesses will do really, really well. But looking at the group of growth stocks at the moment, there's going to be a lot of businesses in there that people are expecting to grow at 20, 30%. And will end up growing at 12% and ultimately disappoint investors, and those stock prices will come down considerably. So to avoid that happening in my portfolio, Amazon is one that I will happily wait for another day. Maybe they'll go through some kind of short-term problem in the future and the stock price will come down, and that will give me an opportunity to invest. Number 2 on today's list is actually one investment that I have in my own portfolio. For those who have been following the channel for a while, you would know that I have 4 significant investments, and one of them is our second stock for today, which is Facebook Incorporated. There were 11 super investors who invested into Facebook during the quarter for an average of 1.9% of their portfolios. In Facebook's case, there were 2 investors who added to Facebook for the first time, and then the remaining 9 were just adding to existing positions. And none of these positions were massive changes. You had Clearbridge Value Trust that added 50,000 shares and doubled their position to about 1.6% of their portfolio. But looking down the list, you can see that these were very, very small changes. For me personally, it's the 4th largest position in my portfolio, and Facebook has done extremely well. Over the past 5 years, it's been a 3-bagger. And while user growth numbers is certainly slowing down and it's reached a plateau in some very penetrated markets like the US and Canada, I'm very confident that they're going to be able to grow significantly, either through moving into new markets, but certainly from their core business through increasing the revenue that they generate per user, which is still extremely low if you compare it to something like broadcast or cable television ads. In my view, Facebook is relatively easy to value. You really just need to take ad rates that you expect to see on things like cable and broadcast television and compare those rates on an impression basis, for example, so how many impressions those ads get, to compare to how many impressions those ads could get on Facebook. And because Facebook's ads are more targeted, you can target people based on age, gender, and location, and interest, and behavior, shopping online. You can target people in so many ways that make their ads more effective. So you can easily expect that people and advertisers would be willing to pay at least equally as much for ads on Facebook as they are currently on traditional means, if not more. So looking at that relationship, you can pretty easily see that, especially in some major markets like North America, that there is a significant room for revenue per user or revenue per click, for example, to go up significantly. And like the other companies in today's list, again, high growth is going to be needed if it's going to deliver a 15% return from this point onward. In Facebook's case, it's probably going to be somewhere between 18 to 20% per year over the next decade if you bought the stock today and wanted to 4x your money over a 10-year period, and that's including no margin of safety. There's a pretty familiar story going on here, and I promised that I would give some commentary about investing in 2021, and I think that what I'm seeing here with these 5 stocks is the exact same that I've seen for all the businesses that I've analyzed over the past year, and even in 2019 as well, for example. And that story is that people are willing to pay significant prices for stocks because the alternative is what, 1% in a bond. So as a result, it looks like investors are either doing one of two things. Either investors are irrationally thinking that, you know, heaps of these growth businesses are just going to grow at 30% per year for 10 years, or it's that investors actually have lower growth expectations, but they're just willing to accept a lower return, maybe a mid-single-digit return, which is what a lot of these stocks look like over the next decade. For me personally, I don't like accepting low single-digit returns, and typically when that has happened historically, when stock market returns have gone that low, typically there's been something that happens that reverts that back to double-digit returns, or at least in pockets of the market where there's some problem that happens in an industry or with a business specifically that sends that stock price down and raises its long-term expected return. So I'm happy to wait and be selective for those unique opportunities. But number one on today's list is a stock that I'm sure everyone is expecting to be number one on this list, and that is, of course, Alibaba, the e-commerce giant out of China. A total of 11 super investors invested into Alibaba during the quarter for an average of 1.2% of their portfolio. Out of those 11 investors, there were 3 new investors. So we had Guy Spear, Clear Bridge Value Trust, and Bruce Berkowitz, all of them added to the position. Guy put 5% of his portfolio into Alibaba, which is significant. And then there were 8 other investors who added to their position. The most notable was Monish Prabrai, who added 50% of his investment, so added another 7% of his portfolio in Alibaba. And the stock actually went down today, and I think the reason why is quite obvious. I think Alibaba stock went down because Warren Buffett's 13F filing came out today as well, and I think a lot of investors were betting on Alibaba, expecting to see Berkshire Hathaway, Warren Buffett's company, to have invested in Alibaba. If that had happened, Alibaba stock would have exploded. And I think there were probably a lot of people who were trying to make a short swing trade on that news event. It fell through, so as a result, the stock fell significantly. So what are my thoughts on Alibaba? I gave my thoughts very, very briefly in a previous video, just at the end of another video, but Alibaba is a business I don't understand, right? I mean, I've even used Alibaba in order to source products for an e-commerce business that I ran, and I still don't understand or have a good grasp on how they will grow in the future. I just can't wrap my head around it, and that's okay. I mean, I can't wrap my head around the vast majority of businesses, but for me, that means that I will not be participating, at least right now. Maybe at some point I do have enough understanding of it, but right now I don't. And my warning for people here is just be careful. Don't blindly clone Monish Prabrai and Charlie Munger just because they're great investors. These investors have made bad investments in the past, right? They're not immune to making bad investments, and if you don't understand it, then you won't know how to navigate that investment. You won't know what's an appropriate price to pay, although I guess if you're cloning, you could just copy the super investors, but then you will certainly not know what's an appropriate price to exit. And, you know, you will only get the 13F filing for when these investors sell 45 days after the period. So you could incur a massive loss during that period if you were meant to sell earlier in the quarter. Basically, what I'm saying is you need to understand the investment too. It's okay to clone a super investor if you understand the business too. It's okay to get ideas. That's why I make these videos, because it can give you some ideas about what these investors are buying. But at the end of the day, you need to understand what you're buying. And if you don't, just invest in an index fund. Don't pick individual businesses. But there you have it. That was the top 5 stocks that were purchased by the list of super investors on Dataroma during the last quarter. Let me know what your thoughts are down in the comment section. Did you invest in any of these companies in the latest quarter? I didn't. I didn't invest in anything in the last quarter, as has been the case for a little while now, as I'm sure some of you are aware. But I'd love to know your thoughts down in the comment section below. As I said at the start of the video, make sure you're subscribed and have notifications turned on if you want, so that you don't miss out on any of the other 13F content that I'm posting throughout this week. But with that said, hope you guys have a great day, and I'll see you in the next video.